In this video, we're going to pit the three different self-directed retirement vehicles up against each other across the same metrics and see how they stack up. All three provide phenomenal solutions to take control of your retirement and grow it methodically for years to come. In putting these three account types up against each other, we know that all three are able to invest in real estate while using non-recourse loans to leverage and enhance returns. But the similarities quickly end there, with contributions being one of the starkest differences between accounts. With a self-directed IRA, you can contribute up to $6,000 in 2020 with an extra $1,000 catch-up if you're over 50 years or older. But with a solo 401k or eQRP, you can contribute 9.5 times more annually compared to an IRA. You can contribute $57,000 in 2020 with the potential for an extra $6,500 catch-up in contributions as well. This is an incredible opportunity to massively grow the potential for your retirement. In looking through these contributions, we found that it takes at least $150,000 of self-employment income to max out your contribution potential. And speaking of self-employment income, this is where the main difference between the self-directed IRA and the solo 401k and eQRP begin to diverge. The two latter requirement vehicles, those require you to have self-employment income to establish and sponsor the plans. Now, the threshold for the eligibility is very low. You just need to have any self-employment income to open the account and roll over current funds into a solo 401k or eQRP. It can be as simple as driving an Uber around town or selling arts and crafts on eBay. Once you have self-employment income, you can open one of those two accounts. Now, why would you go to all of that trouble? Simply put, a solo 401k or eQRP avoid any and all taxes. The same can't be said with a self-directed IRA, which when investing in a leveraged property earns what is called unrelated debt financed income, known as UDFI. UDFI creates UBIT, which is a tax that the IRA must pay. This tax is not insubstantial, though we found that it's not totally detrimental to your investment, so go take a look at our case study video for more info on that. But within a solo 401k or an eQRP, the IRS does not care if you are invested in a leveraged asset. All of your gains are kept 100% tax-free, and those account types can be of either pre-tax or post-tax Roth money. Why not pay taxes now at historically low rates? Put it inside a solo Roth 401k, realize gains for decades on your contributions completely tax-free, and when you retire, have access to all of your money, gains and all, absolutely tax-free. Pay taxes once, and Mr. Taxman will never come knocking on your door again. Another key benefit to a solo 401k or eQRP is the ability to take out a loan of up to $50,000. This loan is not treated as a distribution, nor is it bound to any self-directed retirement rules. Once you take the loan, your funds are treated as everyday liquid cash. You could go buy a car if you wanted. Now, I wouldn't suggest that, but any purchase is available to you. The only rule for the loan is that it must be paid back within 3 years, and the interest rate is bound to within 2 points of the current prime rate, which is currently sitting at 3.25%. So obviously at 5.25%, this wouldn't be a great trick for stuffing more money into your 401k, but there are some creative ways you can go about taking the loan. You can take out a $50,000 loan, invest it into the same multifamily deal you would have invested in had it been in your solo 401k, but you'll be able to take the high paper losses generated by depreciation that multifamily offers. You'd then be able to use those losses for your current taxes and then pay your solo 401k however you see fit over the next 3 years. At this point, we can see that the solo 401k and eQRP have the exact same structures. And that's true until you get to the last 2 points. While both require you to have self-employment income, the solo 401k is limited in that you cannot have full-time employees in your business. I'll pause here and say that your spouse is all right, as well as 1099 contractors, employees under 21, some types of union employees, as well as non-resident foreign national employees. If your business exclusively benefits from the services of these types of employees, you can still sponsor a solo 401k. If not, though, if you do have full-time W-2 employees, you would have to opt out for the eQRP. An eQRP provides the same benefits as a solo 401k while expanding the eligibility. And when you do open an account, you gain ERISA protection against creditors should you ever need it. I want to point out, by the way, that this protection is not established if you open an eQRP but you do not have full-time employees. The benefit is only gained when the account is established as a multi-member plan. Because the additional benefits an eQRP provides only appear if you have full-time employees, we would suggest opening a solo 401k for those who do not find themselves with this employment structure. Simply put, the costs are lower and the benefits to you would remain virtually identical. And that's the end of our matchup. Hopefully this cleared up some thoughts on what is the right retirement vehicle for you and which you might be eligible for. If you have any further questions on which account to choose, feel free to reach out. I'd be more than happy to help.